Welcome back. Still tuned into halftime report on CNBC-TV18. Well, it's turning out to be a session where we're higher by around 0.8% currently for the Nifty, so good going, and the Bank Nifty up around 0.4%. So overall, the barometers or the statistics look good for the markets in today's trading session. So let's talk a little bit about the macros. In fact, we have UBS's Chief India Economist Tanvee Gupta Jain, and we also have Rohit Arora, who's the head of Asia Forex and Rate Strategy, joining in from the UBS India Summit 2025. Tanvee as well as Rohit, thank you very much for taking the time out. Well, Tanvee, I'm going to start with you. The big question is that maybe we could now be, mending ways with the US when it comes to a tariff deal. There could be something on the cards which could be a little more conducive to both nations at this point in time. What is your sense in terms of where things stand when it comes to a possible trade deal?
Sure. Thank you for having me in the show. I would say that's the most discussed topic, even during our UBS India conference. When can India and US trade deal get negotiated and we see some respite from the announced 50% tariff? If you look at, we just launched our 2026-27 outlook, and our base case is that the reciprocal tariff in India, including penalty, which is right now at 50%, gradually comes down to 15% by end of December 2025. I would definitely think about the penalty getting withdrawn earlier by end of November, and gradually we also see some kind of negotiation on the reciprocal tariff. That is something that we are working on when we are looking at India's growth outlook, because that one uncertainty was one of the biggest, I would say, the hindrance for the investors to look at India right now.
Okay. So what are you targeting in terms of GDP growth, and what would that be predicated on based on what you're assuming when it comes to a tariff deal?
So let me talk about both about this year outlook as well as the FY27 outlook. For this year, we are at 6.8% GDP growth, and whatever data we have tracked for the first half of this year, that is April to September quarter, I would say the growth has been holding up very well because of resilient domestic demand and a very, very supportive policy. We have seen both fiscal as well as a monetary policy easing, and including a GST cut which got effective from 22nd of September, and that is kind of holding up India's momentum pretty well. So for the full year, we are at 6.8% GDP growth for FY26. Now going into FY27, we are expecting growth to stabilize around 6.4%. We are slightly below consensus. I think consensus is somewhere around 6.5% of GDP, 6.5% for next year. But we think the growth is going to stabilize around trend. We need to realize that FY26 GDP growth also had a tailwind of a low GDP deflator, which is now going to become unfavorable. But putting a little bit more thoughts on how the outlook is going to shape up in 2026. The first most important assumption is, which our global team is making, that the growth, especially on the global economy, which is going to see a soft patch in the next 4 to 5 months because of higher tariff leading to slow export growth, will actually accelerate from the first quarter of next year. So we are actually expecting a very decent global GDP growth of 3.1% for 2026. So I would say from a global perspective, I think India remains supportive. Now coming back on the domestic factors, I think the biggest driver of growth that we are expecting in 2026 is going to be the household consumption. There has been a stimulus, I would say, or a policy support almost to the tune of $60 billion in FY26, which is going to sustain in FY27 as well. Okay. And on top of that, rural consumption has been looking very good. Yeah.
Okay. So 6.4 is your base case. I'm assuming that's your base case for GDP in FY26?
FY27.
FY27. So what would your bullish scenario be, for example? Would it be 6.5%, which is in line with consensus, or better than that?
So there are two bullish scenarios that can play out for India. One, the global economy turns out to be better than what we are estimating. India is a low beta economy, but for every 100 basis points upswing in the global GDP, we could see a 60 basis point delta on India's growth. So that's one big upside. The second is the AI boom. I know we are talking about the AI boom in US and China, and it is inherently less labor intensive, but what we are expecting that in the initial phase, it will help lead to technology, innovation, improvement in productivity, and can really boost India's growth back by around 20 to 30 basis points in FY27, depending upon the extent of AI implementation that we see in India. And a third upside that can come from is structural reforms, right? I mean, there's a long list of structural reforms that India needs to deliver on land, labor, capital. If we do continue to see more reforms but on the part of the government, I think the growth can definitely go in between 6.5% and 7%.
Okay. Rohit, what I also want to know in terms of the move that we've seen coming in on the dollar index side, how does that place India in this whole story, and what is your outlook, especially coming in from the rupee front?
Yeah, sure. So see, there is a dollar and there is a rupee. The global dollar, we went through a small patch of this de-dollarization, dollar weakness narrative in Q2. And from second half of this year, that narrative has already started to taper because the global investor base has started to acknowledge that AI exceptionalism will start to make a comeback of the dollar against major currencies. So that narrative is very much visible in the markets. We have seen some upside pressure on dollar on that particular factor. But going from here until end of next year, I would say likelihood is dollar will be mildly stronger. We have DXY about a couple of percentage points higher from current levels. Euro dollar about 2% lower. And likewise, most EM currencies about 2 to 3% lower. The only catch is the point which Tanvee made. We are looking at next 12 to 15 months as a year of two halves, or if I could specify, a year of 1 quarter and 3 quarters. The next 3 to 4 months is where we think there's a soft patch coming in US economy, that is higher inflation, lower growth, which is a payback from tariffs. And that is where this possibility dollar first goes through a pullback before it rebounds on AI exceptionalism. So that is the dollar part of the story, which is mildly stronger dollar, but after a small decline in next couple of months. When it comes to rupee, rupee has, of course, been one of the worst performing currencies this year against the dollar. Going into 2026, if the domestic demand starts improving, there could be prospects for rupee to strengthen. But as things stand, we are working with an assumption that dollar rupee may hover around 88, 89 in the next 3 to 6 months and eventually move towards 90 by end of next year. That's partly because of dollar, but also because of the historical track record of rupee being actively managed in the direction of creating higher highs and higher lows.
My God, so 90 is your target on the rupee by the end of next year. But Rohit, just quickly wanted your target on the yield as well, which has been largely flat or for the entire year if you look at it. But there has been strong amount of hardening which has taken place, say, from Q2 to Q3.
Yeah, sure. So it is indeed quite ironical that we have gone through a very aggressive monetary easing this year on top of the bond purchases that are beheaded early in the year, and 10-year yields are basically unchanged from where it started the year. The factors that have been playing around here is, one is a very organic evolution of the yield curve, which is whenever the monetary policy is excessively tight, curves tend to flat, and as monetary policy starts to ease, the yield differential between long end and front end starts to widen. So that was a phenomenon which played out. But the bigger undercurrents in the bond markets have been the elongation of duration or elongation of longer maturity bonds issued by central government and state governments.
Sure.
That has been keeping an upside pressure on the very long end of the curve. And as things stand, we think even if RBI cuts the policy rate by another 25 basis points, which is our baseline, we think the next 20 to 30
Sure.
basis points by end of next year would be higher.
All right, Rohit, as well as Tanvee, always a pleasure hearing your views. Thank you very much for joining in and speaking with us. So that's the UBS macro team talking to CNBC TV18. But